AI is everywhere. It's in your search results. It's in your text messages, your emails. It's summarizing your meetings at work, and it's even popping up in places you might not expect. In fact, almost 8 in 10 companies report using generative AI. Some of the biggest names like the Magnificent Seven are betting big on the technology. Year to date, 3 of their stocks are up more than 20%, and they're all pouring billions of dollars into AI research and infrastructure. Studies estimate that the value of AI in general to be somewhere between $11 and $18 trillion. 8 in 10 companies, the same number that report using AI, have also reported it has no significant impact on the bottom line. Yep, you heard that right, no impact on their bottom line. This lack of revenue impact for AI adopters, combined with incredible price growth of AI creators, is fueling concerns about a possible AI bubble. Famed investor Ray Dalio, Alibaba's Joe Tsai, some economists, even OpenAI's Sam Altman himself, have expressed concerns that a bubble may be forming. In fact, at least one economist warned AI has become a bigger bubble than the dot-com bubble of the 90s. Heightening concerns is the level of concentration the overall market indexes have in these big tech stocks. NVIDIA alone made up 8% of the overall market cap of the S&P 500 as of August 2025.
The concentration issue, it definitely exists, but I think it also has to be looked at in context of the fact that a lot of these companies have become significant drivers of overall income growth for the S&P 500. NVIDIA, which is the largest company in the S&P 500, it's in the tech sector, its market cap is approaching where the entire healthcare sector's market cap is.
That's Schwab senior investment strategist Kevin Gordon. Kevin also said AI capital expenditure spending has driven the growth of GDP for the first half of 2025. The annualized growth of business investment in information processing equipment is close to 40%, which we haven't seen since the 90s. But it's a little more complicated than just seeing concentration and calling it a bubble.
Companies that are sort of at the forefront of that economic growth, they have relatively more solid fundamentals today. And in many cases, they have actual fundamentals. And that to me is an important distinction between today and back then being the late 90s. When you look at the factor or the characteristic in the stock market that was the most positively correlated with the market's returns, meaning what was sort of driving the market higher, it was negative earnings. So it was companies that didn't have any earnings growth, but yet were being bid up consistently and saw relatively significant gains. Today, there are much more sort of positive earnings revisions and sort of actual profit margins and actual profits that are driving the market higher. Today, yes, are there sometimes euphoric characteristics of the market? Absolutely. But is it totally unjustified from a fundamental aspect akin to what we saw in the late 90s? Not necessarily.
If a bubble exists and it does pop, it could lead to major stock losses. Worsen because of the level of concentration in AI in the largest companies. It also has the potential for larger economic fallout. So if you're concerned about the potential for a downturn, let's talk about ways you might manage risk in your portfolio. Long-term investors try to keep a broader perspective by holding a diversified portfolio, which is just a fancy way of saying, don't put all your eggs in one basket. That way, your investments are spread across different securities and asset classes in hopes of offsetting losses in one investment with gains in another. This can help weather market volatility. While markets historically tended to go up, it has often been a rough ride, and past performance is no guarantee of future success.
One of the things that needs to be a focal point is figuring out where your time horizon and where your risk tolerance lines up. I think this is one of those moments where you need to look at your portfolio and see where those align.
By slightly shifting allocation away from the so-called Magnificent Seven, even if you're bullish on AI, a portfolio will still have other irons in the fire, so to speak, with companies that have sound fundamentals and a strong history of performance. For an index fund investor worried about concentration, consider choosing funds that use different weighting formulas. You could find funds that are equally weighted or even fundamentally weighted. That doesn't totally negate risk though. Investors avoiding market cap weighted investments could still miss out on the gains if the big stocks continue to provide incredible returns.
As it pertains, specifically to anything AI related, I think one of the ways to hedge and diversify around that is actually thinking about the difference and the important distinction between the AI creators and the AI adopters. And so much of the focus over the past couple of years, since we've been in this, this AI craze, if you want to think about it that way, the focus has been on the creators. We've spent a lot of time thinking about who are the adopters and who could benefit from the technology. And I think that's going to become an important next leg of the cycle for industries that don't have the ability to be the AI creator.
You could also consider reallocating some funds out of your mega caps with an eye toward the other large cap or mid cap companies, or adjust allocation away from stocks. But this also opens up the risk of missing out on gains. Or if there's a big crash, you may still lose either way. Who knows? Maybe the Dallas Fed is right and we'll end up with an AI utopian world in which the fundamental economic problem of scarcity is solved. Or maybe the other scenario where the machines become malevolent and eventually lead to human extinction. That could happen too. One thing is for certain, AI has the attention of the largest corporations and their investors. It's just a question of how much attention it retains in the long term and how that might affect your portfolio.